Welcome back. Now that we have established a basic understanding of what trends are, now it's time to give a further insight into what market structure is. Let's move a step further. A step further, we'll be talking about swing points. Now, I want you to understand we have two basic types of swing points or two general types of swing points. We have the swing high and the swing low. Okay, we have the swing high and the swing low, and on the charts you can see a diagram which shows you the swing high and the swing low. Now, what is a swing high? A swing high is basically a failure to close above a certain level, and hence there is a sign of exhaustion, which in this case an exhaustion from bullish prices to push price further high and subsequently the bears take over. While a swing low is basically a failure for price to close above a certain level and hence shows a sign of exhaustion for, in this case, the bears to push price further lower and subsequently the bulls take over. I know you're bored with the grammars and all, but from the diagram above, you should basically be able to see what a swing high is and what a swing low is. Also, the diagram might not do a lot of justice to what I said, so let's go to the charts and see what a swing high or a swing low is. Now, before I go, let me tell you something. We said a swing high is the failure for price to close above higher from a certain level, which in turn, the bears take over. What it basically means is price was going up, okay? And all of a sudden, price couldn't go up anymore due to exhaustion, due to the weakness in bears, due to weakness in bulls to be precise. They couldn't push price higher further, so price started going down. This point is what is considered as a swing high. Now, the bears take over and start pushing price lower, and the bears couldn't push price lower anymore. The bulls came in and took over. This region is what we consider as a swing low, okay? So these are just points in price where there is exhaustion in price and one part of the market comes in charge and takes over the strength in the market at that period of time. Now, it is important for me to explain to you that swings in price basically take place at significant levels, which you must find on your chart. So let's go to the charts. Enough of the boring story. Let's go to the charts, okay? So on the 4-hour time frame, that's where we'll be taking it from, and we'll be using the Uniswap chart. Look at this point right here. This high is considered as a swing high because price couldn't go high any further and price started going down, okay? This low is considered as a swing low. This is a region in price where price couldn't go down any further and started going up. This region is considered in price as a swing high. Price couldn't go up anymore and started going down. This region is considered as a what? Swing low. Price couldn't go down any further and started going up. This is a what? A swing high. This is a what? A swing low. This is a swing high. So basically, these are easily spotted on your chart. And another thing, like I said previously, is they must be found on significant levels. When we're talking about significant levels, we're basically talking about support and resistance. Okay? Support and resistance. Now, look at this real quick. Just real quick. Look at this. Where was this swing low found? It was found at resistance turned support. Let's go one more step further. This swing high was relatively close to what? Support, which in turn is acting as resistance. Another step further. Where did these swing guys build up at? These swing guys, they basically built up at what? Previous support, now turned resistance. So basically, they must be found at significant levels on the chart. Okay? Now, understanding this, I know you may be wondering, what is the importance of swing points when you already understand what support and resistance is? But I'll tell you the truth. You see, swing points are regions in price where a break in market structure can literally occur. Okay, or basically they can occur. Swing points are places in the markets on the charts where break in market structure can occur. And let me tell you something, if a low or a high has been violated by a candle close, okay, once a low, which is this low, has been violated by a candle close, price goes through it and price closes below it, it means the market direction has shifted. Okay, it basically means the market direction has shifted. Okay, now understanding that this is just an important idea or concept to understanding the basic characteristics of a trend. Now I want you to understand something. If we have a higher low and the general direction is a downtrend, okay, like this higher low, now if we have a higher low and the general direction is a downtrend, it means price will continue going down because of it was not violated yet. But once it gets violated, it means price has a tendency of moving a bit higher, and vice versa if we are in a uptrend. Okay, so if we have a higher low in an uptrend, if it's not violated yet, it means price will continue going to the upside. So I best believe you have a proper insight into what swing lows are, and we will be moving a step further into what really matters, which is break the market structure, in the next video.